And then share my screen. So, are you seeing the slide deck?
Yes, thank you.
Okay. So I think this is where we left off last time. So last time we went through this OSAP, which is kind of our note 1 and 2, but there is some crossover between what we're talking about here and note 2, which is the stewardship disclosures. So the detailed notes, we talk about changes in accounting, prior period adjustments, changes in estimates, expand on summarized information. Our note 3, we run through the balance sheet, or a lot of it anyway. And then note 4, it's more of contingent liabilities and more esoteric liabilities like post-employment items and environmental remediation and landfill. So the link takes us to our note 3. So we start through and go through the cash and investments, and then there's just kind of different ways of looking at our cash and investments. We ended up last year with about 2.6 billion. And then we break it out by restricted and unrestricted. And then we analyze the restricted portion by the different funds. And then theoretically that should tie back to the restricted total up here of 1.3 million, 1.3 billion. So, and then we talked briefly about Prospero, which is our component unit. We talked about custodial risk. And investments, fair value inputs and methodologies. And the fair value hierarchy is fairly new for us, but I think it's pretty similar to what FASB has been doing. So level 1 is pretty much tied to active markets. Level 2 is to observable inputs, and level 3 is unobservable inputs. And this is kind of our breakdown. So we really don't have any level 1. Primarily, we're into bond markets. So we got U.S. treasuries. We call them U.S. agencies, but they're really things like related to like housing bonds. So there's the Federal Home Loan Bank, and then there's a few others in that category. We're calling them agencies, but technically it's really just kind of an implicit backing that the federal government provides to them. If you go on to like the Federal Home Loan Bank and look at their disclosures there, they're saying that they're backed by mortgages. But everyone believes that if they went under, then the federal government would step in and prop them up. We've got some corporate bonds, some municipal bonds, and there's there's a repurchase agreement. And basically the way those work, if you're not familiar, is like overnight, we will take our cash and the banks will invested overnight in some kind of bonds, so that we get a little bit better interest overnight. And then in the morning, they return the cash back to us. And that's pretty common in government. It's a way of getting a little bit better yield than just leaving your cash sitting overnight in a cash account. So the bulk of ours is level 2. The company that the broker that we go through to handle those transactions value them for us. So we get a report at the end of the year telling us whether they're level 1 or level 2, and it ends up being level 2. And then we have some categories that are amortized cost, the bulk of which is the local government investment pool. And you'll hear that called LGIP. So that's the state of Oregon has a investment pool that all the governments pretty much in the state have an account at. And it's a way to move money back and forth between us and the state, or between us and other governments in the state, so we can move the cash up to the LGIP and then have them transfer it to like Multnomah County. So it's kind of a handy tool. And the interest that we earn there varies over time. I think last I heard it wasn't too bad. So anyway, that kind of gives an idea of where our cash is parked and invested. So we do some more discussion about that. Interest rate risks, credit risks. And here we actually go into what instruments we have. So Federal Home Loan Bank is the biggest, but not by much. So pretty much all the way down through federal agricultural mortgages, those are backed by mortgages of some kind. So that's where the bulk of our money is. We do actually have some in treasury notes, and then corporate bonds. And the council has prescribed some ESG factors that kind of drive what kind of corporate bonds we can own. So then we got to talk about our concentration of credit risk, custodial credit risk, income risk, and then all these different types of risks are prescribed by GASB that we have to talk about. And this is kind of our mark-to-market situation. So last year it was about 2 million, $1.5 million. Wouldn't be surprised if it's a much bigger delta this year between market and book value, because of all the interest rate fluctuations, with interest rates going up dramatically. It wouldn't surprise me if we have a fairly significant loss in the markets this year, but we'll have to wait and see what Treasury comes up with. And they'll be doing that entry. So we do 3 rounds of settlements during closing. So I think it's around July 8th, we do the first round of closing. And after that round, that's where Treasury figures out the mark-to-market entry and allocates it across all the funds based on the cash balances as of the end of round one closing. And then we do 2 more rounds of closing in order to get through, allow everybody to do everything that they need to do, and then hopefully be done with AP 12 and open it up for 13 so you all can start doing your job around, I think it's July 19th or so, 18th, somewhere along in there. Then we move into receivables, and we break it down by the types of receivables, and then the allowances that are set up. The biggest portion of our allowances we'll get to in a minute, but we got $500 million in allowances for uncollectibles. And most of that it has to do with housing loans. And then so this is governmental activities, which again is our governmental funds and internal service funds. And then business type activities are our enterprise funds. Then we get into the loans receivable. So Housing Bureau, we break out by fund and by type of loan, and each one of these loan types has different repayment factors. Now, one project that we need to do at some point is to go back through and analyze what this allowance should be for each of these loan types. So at the moment we got, or at June 30th of 21, we had $605 million of loans outstanding. And we set up an allowance for uncollectible for $521 million of that. Housing in the past has said that they think that allowance is too high, that we really will collect more than the 83 million that we're saying here. But we just haven't had time, and housing hasn't had time to go through and really do the analysis. Because we'd have to go through each one of these loan types and look at, okay, cash flow loans, what are the characteristics of a cash flow loan, and what are the probability that we won't collect on it. So that's a project we're going to have to take on at some point. But housing has a lot of new people, and we've got other projects that we've got to deal with first. But this is something that we're going to have to deal with at some point in time. And so if you got any interest in taking on a project like this, you can talk to Kevin about it. Because it'd be kind of interesting, actually, to really dig in and look at all those different types of loans and really take a good analysis of it and figure out what should our allowance actually be for these loan types. We've got some HUD Section 108 loans, housing preservation, and so it was this set of loans were basically setting up a really high allowance for uncollectible with these. So it's 100% with this group, which are the cash flow loans. And basically what a cash flow loan means is the developer is running a housing project, and they're doing it at affordable rates. So they're not market value. So if they have a positive cash flow in any given year, then they have to make a payment on the loan. But if they have negative cash flow, then they don't have to make a payment. So the kind of expectation at the moment is we're saying that these particular projects will never have a positive cash flow, and we will never get any money back from them. So anyway, another project for the future. Vaught has this $125,000 loan that was made years and years ago, but it's coming due here in a few years, and it'll be interesting to see if we collect on this one. It was related to a housing project that was done, the Belmont Dairy. It's a property down on Belmont, kind of in the Hawthorne area. BES has a couple loans that are outstanding, and if you're interested, you can dig in and look at those. Payables, these would be just our accounts payable, broken out by type, and deferred outflows and inflows of resources. This one gets more complicated. For governmental funds, it's primarily the deferred inflow, which is basically revenue. So when the governmental funds book a receivable, it will be offset by deferred revenue. And we only can recognize revenue to the extent that we expect to receive the cash by August 31st. So there's a big, at least for assessments and property taxes, most of the receivable is offset by deferred revenue. So that's what we're dealing with here. Now here we're getting into economic resource measurement focus and accrual basis of accounting. And here we've got all of the different types of deferred outflows and inflows, mostly related to pensions and other post-employment benefits. And there are a whole bunch of different types. And at some point we'll get into pensions here a little bit more depth, but these are what these are related to. Deferred inflows and outflows are kind of a weird thing that only exists in governmental accounting so far. And kind of the best example or metaphor that I've heard for what these really are is that they are a parking lot for things that are going to happen in the future. So a deferred outflow is where you park expenditures that are expenses that are going to be related to a future year, and we don't want to recognize that expense this year. And the same way with inflows, it's revenues that are really related to a future year that we're going to hold here in the deferred inflow section until those revenues should be recognized. Now, where that falls down a little bit is really should we be deferring those or not? Most of these have to do with post-employment benefits of one type or another. When GASB put out GASB 68 and 75, which relate to pensions and OPEB, and told us what the accounting was, they felt like, given how widely a pension liability or an OPEB liability can fluctuate from one year to the next, that they didn't think it was fair to make people absorb the entire change in a given year. So what they did was, okay, so if you have a change in your pension liability because of a change in between expected and projected earnings, or experience, or change in assumptions, then we park it in deferred outflows and inflows, and then spread that out over generally around a 5-year period. Conceptually, it was kind of a nice idea, but I think in practice, it's just created a massive accounting problem, because you've got outflows and inflows that have accumulated over a 5-year period, and they're all amortizing it. It's just it's complicated. Fortunately, the actuaries do it most of the work for us, but still, we actually should see some big ones this year. As we should see a significant, so for the discount factor for FPD&R's pension liability is basically a AAA bond rating, and the interest rate there has gone up fairly significantly, so our liability should go down fairly significantly. But that reduction in liability will mostly go into a deferred inflow and be spread out over 5 years. And then similarly, PERS had a really great year. I think they made like 20% on their investments last year. So the net pension liability went down dramatically. So we'll have a big number that will get buried in there. So fund balances for governmental funds, we have to break them down by non-spendable, restricted, committed, assigned, and unassigned. And those of you who are doing governmental funds will have to go through this process of figuring out all those different categories and allocating fund balance out across these different buckets. What this is when GASB put out this statement, they said, well, you could put all this detail on the face of the statements if you want, or you can just summarize it on the face of the statements, and then in the note disclosures, give us all the detail. So this is a good example of, we've summarized information in the financial statements themselves, and now in the note disclosures, we are breaking it out and telling the reader in detail, like the restricted, that this portion is for drug enforcement, this is for fire capital, this is for capital improvement projects, etc. So here we're just telling the reader in a more granular way what makes up those balances on the face of the financial statements. Capital assets, we basically have to show the beginning balance, increases, decreases, and reclassifications. So most of our reclassifications have to do with costs have been accumulating in construction in progress. And then when a project is finished, then we're moving it down into all these different categories of buildings, infrastructure, improvements in land, equipment, etc. And we do this for governmental activities and for business type activities, and then in total. And then we got a regulatory asset now for water. And then we have to break out depreciation by functional area. And then we have to do a similar disclosure for Prosper Portland's capital assets. Interfund receivables, payables, and transfers. We have the general fund owing FPD&R money, and this is something that the general fund person will have to figure out. And then we have our due tos and due from Prosper Portland. And that is based on whatever Prosper Portland basically tells us it is. Because for us, all this stuff is just buried in accounts payable and accounts receivable, and there isn't an easy way for us to figure out how much is related to Prosper. So we let them tell us. Interfund transfers. These are non-exchange transactions that is moving money back and forth between one fund and another. Now, the budget office, but sometimes budget stuff has a transfer when it's really an exchange transaction. So we have to go through a process of reclassifying stuff like that. And whoever's doing the the new park levy fund, they set up a big transfer between them and general fund that excuse me, it's gonna have to be reclassified. Interfund loans, those are just, or one fund is loaned to another fund. Money. We have to detail out the prepayment schedules. Leases, this will be totally all different this year. Then we can skip over that. Long-term debt, we have to go through and break out each of our categories of bonds by type. So these are the GO bonds and limited tax improvement. So for each type, we list out each of the issuances and the remaining balance. And then we have to do a table showing how much is going to be paid back each year. And then in 5-year increments after the first 5 years. So lots and lots of debt. But it's a good area to learn and study, because you learn a lot about how the government works, because we're highly dependent on debt to make everything work. And I call the other, we got about $3 billion in debt outstanding. So you go through all those individual types of loans and bonds and lines of credit. And then we finally get to kind of a summary page. Somewhat similar to what we do for capital assets, where you have the beginning balance, reclasses, additions and reductions, and ending balance. And then here we detail out how much is owing in the next 12 months. But although the note focuses on all these different types of debt, here in this table we also add in self-insurance claims and pensions. OPEB and any other types of liabilities. My voice is going. And then we talk about short-term debt. And it's a comment. It's a combination of defer and tax increment or tax anticipation notes. And then termination benefits. And we move on to note 4. We'll talk about risk. The different types of risk we got in the landfill and environmental remediation. And commitments and contingent. And a summary table for that. This is basically all of our purchase orders that are remaining outstanding. Environmental in the Portland Harbor. We don't really know what the Portland Harbor is going to be. We do have a small portion of it. I'm guessing it's over $100 million, but we don't know enough about it at this point and stuff. Not only what the total bill is going to be, but how much of that total bill belongs to us. And then this is some contingent stuff. And then we get into OPEB. We got 2 types. We got our own. And that's basically health and insurance continuation, where retirees can continue to buy insurance from the city at the same rate that the city employees pay until they hit Medicare age. And then there's a PERS related one that doesn't impact any of us because I think it's just tier 1, maybe tier 2, or where we are all OPSRP, or basically tier 3. And then we have to just have a lot of information about what the actuaries do and how they do it. Then we get into the retirement systems. And we got state PERS. Yeah, and FPDR. And at some point, we'll go into all this in more detail. It is all kind of fascinating. If my voice would work. Oh, still pensions. And I think most of these notes have already been written for this year, so I think we're okay with those. And it's kind of a summary. So this is FPDNRs where it's being paid by a a property tax. So we really don't have much in the way of planned assets that we can offset the liability with, which is why governmental activities net position is negative.
Oh, Ron, I had a quick question about that one. Can you scroll up just a little bit for me? Yeah, I was just curious because I saw like at the top it says balances at 6/30/2020. It looks like it's talking like these are just like balances, and then at the very end, like at the bottom, you say balances at 6/30/21. Usually, like this one is just showing the balances, but sometimes you'll see kind of like activity going on. Is the activity summarized more in like a written format, and then like this is the purpose of this chart is just to show the balances?
Well, so this shows you how the actuary got from 6/30/20 to 6/30/21. So there was a service cost adjustment and interest on total liability, effects of economic and demographic gains and losses, changes in assumptions, and what we actually paid to beneficiaries.
Okay.
Well, here they're trying to walk us through how we got from the end of last year to the end of this year.
So then it also, oh, sorry, go ahead.
No, it's okay.
I was just saying, actually, when you said that, then it actually reads top to bottom and it also reads left to right.
Yep.
Got it. Okay. Okay. Interesting.
So you have, for these, you have to have, what is your pension liability as determined by the actuary? And then you have to have, well, how much does, in this case, FPD&R actually have in the bank? And then the net of that is the net pension liability that we actually book on the face of the financial statements. So if you look back at the government-wide financial statements, you would find the $4.5 billion liability is what we booked. And then you have to do a sensitivity analysis with changes in the discount rate. And this is based on, as it says, the bond buyer 20-year bond index. So we know what that was at June 30th, and then we just add 1% and subtract 1%.
Mm-hmm.
That provides the reader with a sensitivity analysis. And I don't know what it'll be this year, but it wouldn't surprise me if it's up to 3 or 4%. So, I mean, you can see if this year we go to 3%, our liability is going to go down dramatically. And then we talked again about deferred inflows and outflows. And then you have to have an amortization table showing what those are going to be over the next 5 years. And then more information on how the actuary does their work, what their assumptions were. And we have to talk about tax abatements. And these are basically where we've offered people a reduction in their property taxes in exchange for mostly low-income housing. But there's also historic property and enterprise zones. So we have to basically disclose how much tax revenue we lost because of those abatements that the city council gave to people. And then we get into subsequent events. And the bulk of our subsequent events has to do with debt activity. But there can be things other than that we have to talk about if anything significant happened after June 30th and before the financial statements were issued. So that's kind of a very fast run through. To give a real basic idea of what goes into the detailed notes. Management discussion and analysis is one of the required supplemental information, so we have to do so RSI. So this is to provide an objective and easily readable analysis. It comes after the audit report, and like all RSI, you have to include everything that's required and relevant, but you can't go beyond what is required. It's not audited, but like all RSI, the auditors read and apply limited procedures. So it starts off with a financial highlights. So we try to hit important issues that happened during the year. And then you go into kind of boilerplate where this section really doesn't change much from one year to the next. Just basically providing the reader with a summary of how financial statements are put together, and then we go into a government-wide financial analysis. Then we have some comparative tables. We do this year to last year, but I've seen some governments where they do 3 years. So the table gives kind of a summary of what the big changes were, and then I have to talk about it. And then we do something similar for the operating or flow statement, comparing this year to last year, and then again talking about it, what the significant issues were. Now, one of the common complaints is that people don't do a really good job of explaining why. And I need to work more on improving what I do. So temptation when you get to this section is to talk about what happened and not why it happened. But really the focus here is supposed to be on the why. What caused things to change the way they did change? So you start off with talking about the government-wide financial statements. So that would be your economic resources and accrual-based government-wide statements. And then you have to talk about your governmental funds and what happened there. There you're switching over to the current financial resource and modified accrual for the government.
Ron, I have a quick question.
Sure.
So on this part, you mentioned the focus is more on not so much talking about what happened, but more in terms of why. And so like when I think about like doing an analysis on why something happened, I usually think about like the changes from either one year to the next, or like, you know, the changes in a trend that was expected, or changes in some sort of like in the way that operations are functioning. And so sometimes I'll think about like a benchmark. How do you think about in terms of like what is important enough to address the why? Like when you're going through and you're thinking about this, what's I guess kind of the benchmark in terms of what makes you think we should talk about the why on this?
Well, I don't know if we've gotten into it yet, but and let's see if we got Schedule 77.
Okay, so
Is
there
what,
is some sort of materiality that we're thinking about.
so there are a number of ways that you can approach defining materiality.
Mm-hmm.
So like if it's a listed corporation, they will often do it based on like earnings per share. But because governments are odd. Another way to do it is to look at revenue and expenses and expenditures. So when I audited governments, this is what we used. So basically you add revenues and expenditures or expenses together by each of the opinion units. We kind of talked about opinion units. So for us, what the auditors are looking at are opinion units. So they're looking at general fund, transportation, and grants, sewer, and water, which are our 5 major funds. And then they look at the remaining information and they look at the government-wide numbers. So in this analysis, we add those together, get a total, and divide by 2. And then you take a risk factor and multiply that times that number to get to primary materiality. So what we're saying with primary materiality is we don't want the cumulative errors in the general fund, for instance, here, to exceed $83 million. So you didn't really want to be looking at big items in the 5, 10, or 20% range.
Okay.
So if I'm talking about the general fund,
Okay.
I'll probably start looking at, well, is it greater than 10 million or so? And when you get over to government wide, you're really talking more like 20 or 30 million dollars. To be something that you really want to start focusing on, because your primary materiality for the government wides is like $235 million. So really big numbers.
Yeah.
Now, I don't know. I'm not totally clear as to how Moss Adam does it. My understanding that they kind of do it this way for governmental funds, and then for the proprietary funds, they're looking at it like assets, a percentage of assets rather than this approach. But over the years, it kind of figured out that what we're doing here is pretty similar to what they're doing, because what they're concerned about really kind of ties to what we're saying is something we should be concerned about here. So anyway, this is what we use for, and what you guys should be using for when you're doing funds, and really trying to look for issues. So if you're doing general fund and there's a question about $900,000, should we make this correcting entry or not? That's what, 1% of materiality.
Mhm.
So if it's early in the process, we might go ahead and make the $900,000 entry, but we have passed on $900,000 entries in the general fund before, and the auditors haven't said anything about it. So you need to be looking over here when you're doing your funds and trying to, is this something I should be spending time on or not? And if it's not material, you just keep moving on. Because now that's when you're doing the ACFR. Now, when you're doing pro formas, you should be looking at a lower level of materiality than this and trying to make sure that we're getting things as close to right as possible. But when we're doing the ACFR, we've only got 3 weeks or so to do the funds. And we just can't stop and worry about immaterial things. So anyway, that's kind of what we use for figuring that out.
Thank you so much for putting that into perspective.
So here we talk about our major funds. Basically, we talk about general fund, transportation, grants, and then we go on to the proprietary funds. And then the next section is we have to go and talk about general fund budgetary highlights. Now, this is where I think it's Schedule 56, where we show how the budget is flowed during the year. So we start off with a beginning budget, and we do a fall bump and a spring bump. And then there's grant adjustments and other smaller adjustments that happen. So I use that audit schedule here to start looking at how the budget itself changed over the year and talk about the why of that. And then we have a capital assets section where we talk about capital assets and we talk about debt. So again, we're talking about looking at big capital asset projects and big debt things. So again, we're based on materiality. I'm trying to just look at the really big projects. And then and these tables just kind of auto populate or tied back to the note disclosures. Then we talk about our debt ratings, and this just comes from the debt office. And then some debt ratios. And again, I think most of this just auto populates and ties back to other places in the financial statements. And then the city economist writes this section. That's kind of that one. And these are the things that have to be there. Discussion of the basic financial statements, condensed comparative data, analysis of government's overall financial position, analysis of balances and transaction in individual funds, budgetary variances, capital assets and long-term debts, currently known facts and decisions. And again, you're kind of limited here. I mean, you can't be very subjective. You got to be really objectively, this is what we know, and this is what's actually happening. Now, we've also have a transmittal letter that goes up in the front introductory section. And that's where Michelle, who writes that portion, can start talking about some more subjective things. So you have a whole lot more flexibility about what you can say in that particular section than you can here in the MD&A. Because anything that's RSI, you just have to do exactly what Gatsby says we can do, and nothing more, nothing less. So we didn't make it very far, did we? We can talk about other RSI next week. I hope my voice is better by then, but I just don't talk a whole lot, so doing a lot of talking like this tends to burn my voice out, which is why we got to get you all starting to do some presentations here once we get past the blue book. So start thinking of topics that each of you would like to present, and maybe start putting some slide decks together. But I do have a number of other topics I want to talk about once we get past the blue book. But I will have to write those up while you're working on the ACFR. Any questions or?
Thank you. That was very helpful.
Thanks, Rowan.
Yeah, thank you. No problem. Take care.